Good evening. Please come to this wonderful standard IFRS 9 for the last time. Okay. Cash flow hedge. We have seen accounting of fair value hedge. In case of fair value hedge, the change in fair value of derivative will be recognized in profit and loss account, and change in the hedged item also will be recognized in profit and loss account. So both will go to profit and loss account at the same point of time. However, if the hedged item is equity instrument measured at FVT OCI, then in that case, the change in the fair value of derivative will be transferred to OCI. Okay, so that was about fair value hedge. The objective is to protect the fair value of a recognized asset, a recognized liability, or an unrecognized firm commitment. In case of an unrecognized firm commitment, the change in fair value of derivative and the change in fair value of the firm commitment both are recognized in P&L account, and when the related asset and liability is recognized. When the related and the liability is recognized, that time the balance in that firm commitment account is adjusted in the carrying amount of that asset or liability, right? So that was a quick summary of fair value hedge. Now cash flow hedge, very important for the exam purpose. What is the name? Cash flow hedge. So what I am trying to hedge? Cash flow, inflow and outflow of cash in future. If I am having an inflow, like for example, I am going to sell inventory, I have inflow. What is the risk there? Selling price may reduce, fall, and I will have lower cash inflow. Outflow. What is the example of outflow? I have to purchase, but then the price may go up. I will have to pay more cash outflow, right? If it is a variable rate instrument, like for example, a variable rate liability, interest rate is LIBOR plus 2%. So if the LIBOR rate goes up, you will have to pay more interest. If you have invested in a variable rate instrument, then if the interest rate falls, LIBOR falls, you will receive less amount of rupees. Okay. So therefore you want to protect yourself from such risk. In case of outflow, you want to ensure that outflow should not increase, outflow should be reduced. In case of inflow, you want inflow should not reduce, inflow should be higher. And therefore you can use the hedge instrument. Like for example, forward, future, option, swap. Okay. So what is a cash flow hedge? Variability of cash flow that is attributable to a particular risk, attributable or associated with a financial asset or financial liability or a highly probable forecast transaction is protected. Is it right? So in short, the hedge to protect the variability in cash flow. Example, interest rate payment on variable rate debt, variable rate liabilities like loan, variable rate asset like investment in bonds, where the interest rate is variable, or any contract that we are going to enter into future, like purchase, sale in future. Okay. So now we'll come to the important accounting principles in cash flow hedge accounting. So I have made a complete summary of what you will do if a cash flow hedge meets the condition for application of hedge accounting. So when will you follow hedge accounting? When certain conditions are fulfilled, which was already presented to you earlier. Do you remember? Cash flow hedge should be highly effective. Management should document which instrument they want to hedge, okay, which asset or liability they want to hedge, what hedging instrument they want to use, what is the risk management philosophy. So assuming that all those conditions are fulfilled, then proceed further. Change in fair value of hedging instrument means derivative will be initially recognized in other comprehensive income. So we are moving from a normal accounting of derivative. Derivative change in fair value is routed through P&L account. But if derivative is used for cash flow hedge, derivative is used for cash flow hedge, the change in fair value of derivative will not be transferred to P&L account, but it will be transferred first to OCI, okay, and then it will be shown in statement of changes in equity. So one effect will be in your OCI, and then when you prepare the financial statement, it will appear in statement of changes in equity. So it's a reserve. You will create a reserve. You will give it a name. What name? Cash flow hedge reserve. You can give it a name called cash flow hedge reserve, unrealized gain or loss on cash flow hedge reserve, okay, hedging reserve, some name you have to give. The ineffective portion of the change in fair value of the hedged instrument, if any, is recognized in profit and loss account. Now this is only peculiar to cash flow hedge, not for fair value hedge. The total gain or loss will be actually divided into two parts: effective hedge, ineffective hedge. Effective hedge, ineffective hedge. Ineffective hedge portion will be transferred to P&L account, and effective portion will be transferred to OCI. Then the student is asking me, how do I know what is the effective portion of hedge? For this you have to do this calculation. Point number 2. Point number 2 will give you effective portion of hedge. Anything more than that is ineffective, and ineffective will go to P&L account. So what is effective hedge? The amount recognized in OCI should be lower of the two. Lower of the two, underline 1. Cumulative gain or loss on hedging instrument. Cumulative means from the beginning till the reporting date. Cumulative gain or loss on hedging instrument from the inception of the hedge. Suppose you have taken a forward contract. Then from the beginning till reporting date, calculate the cumulative gain or loss. Okay. And then similarly, cumulative change in fair value or present value of the expected future cash flow on the hedge item since the inception of the hedge. Since the inception of the hedge. That means in short, calculate cumulative change in both the hedging instrument also and the future cash flow of the hedged item also. Whichever is lower, that is effective hedge. And if the gain or loss is more than that, the additional gain or loss will be treated as ineffective portion. Ineffective portion will be recognized in P&L account. Only effective portion will be carried forward. Now what do you mean by effective or ineffective? Here briefly understand. Suppose that loss on derivative is 100 rupees. Loss on derivative is 100 and gain on the hedged item say 80 rupees. Gain on hedged item is 80 rupees. So which is the lower of the two? 80 is lower than 100. 80 is effective and 20 will go to P&L account. Is it right? Which means, for example, if the loss on derivative is 60 and the gain on the hedged item is 80, entire 60 will be treated as effective. Entire 60 will be treated as effective. Again, loss on hedging instrument derivative is 60 and cumulative gain on the hedged item is 80. So up to 80 is effective. Up to 80 is, more than that is ineffective. So this is a little complicated calculation, which I'm going to take in one example. And then point number 3, if the cumulative change in the hedging instrument exceeds the changes in hedged item, that means change in derivative is more than change in hedged item, the ineffectiveness is recognized in profit and loss account. If change in derivative is 100, change in hedged item is 80, 80 will go to OCI, 20 will go to P&L account. If the cumulative change in hedging instrument is less than the change in hedged item, suppose derivative change is 60, change in hedged item is 80, then there is no ineffectiveness. Entire change in fair value of derivative will be recognized in OCI. Or in short, I can say if the change is up to the change in hedged item, change in derivative is up to the change in the hedged item, then it is effective. But if it is changing more than the hedged item, then that extra amount is ineffective portion. Ineffective portion will go to P&L account in the same period. Point number 4, for cash flow hedge of a forecast transaction. What do you mean by forecast transaction? I am going to buy or sell in future, but there is no commitment right now. It's only highly probable. It's highly probable that you are going to buy inventory, you are going to sell inventory, you are going to buy fixed asset, sell fixed asset. For cash flow hedge of a forecast transaction which subsequently results in the recognition of a non-financial item, like for example purchase or sale of fixed asset, purchase or sale of inventory, or where a hedged forecast transaction for a non-financial asset or a non-financial liability becomes a firm commitment, From a forecast transaction, it becomes firm commitment. What is the difference? Forecast transaction means you are likely to enter into that transaction, and firm commitment means you will enter into that transaction because there is a contractual arrangement now for which fair value hedge accounting is applied. The carrying amount of that item means carrying amount of fixed asset, carrying amount of inventory, or carrying amount of this firm commitment will be adjusted for the cumulative gain or loss recognized directly in equity. So whatever is my cash flow hedge reserve account, because you are giving one effect in the cash flow hedge reserve, that will be adjusted in the carrying amount of fixed asset or carrying amount of inventory or carrying amount of firm commitment. So you will remove that cash flow hedge reserve from the books and it will be adjusted in the carrying amount of asset, inventory or firm commitment. So that was point number 4. All these points we will take in problems. Okay. Point number 5, for other cash flow hedge. That means here the hedging is not for a non-financial asset. Hedging is not for a non-financial asset. So mostly it will be financial asset only. Is it right? So in that case, the cumulative gain or loss which is recorded in equity will be reclassified to profit and loss account. But for non-financial asset like machinery, inventory, it will be adjusted against that item. But for financial asset item, it will be transferred to profit and loss account. In the same period, in which year you will transfer to the P&L account? In the same period in which the hedged expected future cash flow affect the profit and loss account. For example, when a forecasted sale occur. So you keep accumulating in OCI account every reporting period, and the year in which sale will be recognized, you will transfer from OCI to P&L account, so that the sale and the gain or loss on derivative both go to P&L account in the same year. Is it right? Where there is a cumulative loss on the hedging instrument, OCI account debit balance. Cumulative loss on hedging instrument means OCI account has a debit balance, and it is no longer expected that the loss will be recovered. Then it must be immediately recognized in profit and loss account. So continuous debit balance in OCI account, and in case if you think that loss will not be recovered, then only you transfer it to P&L account. Point number 7, if the hedge forecast transaction subsequently results into recognition of financial asset or financial liability, OCI will be transferred to P&L account. So this is right in brackets similar to point number 5. Other than non-financial asset or non-financial liability, any other item, for any other item, OCI balance will be recognized in P&L account. Only for non-financial asset liability like fixed asset, inventory, the OCI will be adjusted in the carrying amount of that asset or liability. But for other cases like sale, like financial asset, it will be transferred to P&L account. In your book, there is one more point number 8, which I will read from your book. Point number 8. Hedges that no longer meet the criteria for hedge accounting. Hedge accounting can be applied only if it meets the criteria for hedge accounting. Hedge must be highly effective. Okay. Then suppose it no longer meet the criteria for hedge accounting, then the standard will give you a punishment. In this case, the cumulative gain or loss on the hedging instrument that has been recognized in OCI from the period the hedge was effective shall remain separately in equity until the forecast transaction occurs. So whatever amount you have accumulated in equity, let it remain there. Transfer it to P&L account only when the forecast transaction will occur, even though you are not eligible for hedge accounting. But of course, after this, the change in derivative will be recognized in profit and loss account. Suppose on 31st July, we found that we are not meeting the condition for hedge accounting. So up to 31st July, whatever amount has been accumulated in OCI will remain in OCI. And then from 1st August onwards, change in derivative will go to P&L account. And what will you do with this balance in OCI? Whenever the forecast transaction will occur, in that year it will be transferred to profit and loss account. See this diagram also. A simple diagram conveys a lot of message. The total gain or loss on derivative divide into two portions, effective or ineffective. First calculate the total gain or loss, then calculate the effective portion. Effective portion is lower of the two. Cumulative change in fair value of hedging instrument, cumulative change in the fair value or present value of the cash flow from the hedged item. Take lower of the two, that is effective. Transfer to OCI. Through OCI, it goes to statement of changes in equity. Ineffective portion directly transfer to P&L account. Now it will remain in OCI, and the year in which the cash flow of the hedged item is recognized in P&L account, like in case of sale transaction, purchase transaction, the OCI will also be transferred to profit and loss account. That means we will go together. Means the hedged item and the OCI both will go together to P&L account. Only the effective portion. Okay. Except if it is for a non-financial asset, then in that case it will be accounted under the head asset. It will be adjusted in the asset. So summary, effective portion into equity, ineffective portion into P&L account. So just to summarize again, topic is little heavy for the beginners. Cash flow hedge accounting step 1. Compare the cumulative gain or loss on hedging instrument. Suppose 40. Okay, 140. Compute the cumulative change in present value of cash flow from hedged item. Suppose 110. Pick up the lower amount, 110. 110 is equity, effective. Transfer to any reserve through OCI, cash flow hedge reserve through OCI, and 30 is ineffective, will go to P&L account. What is the advantage of this cash flow hedge accounting? Can be explained with the help of this small diagram. Again, hedged item, let us say sale, let us say contract to sell inventory after 2 years. So when I am going to sell after 2 years, I will transfer it to P&L account sale. And I have taken a derivative for this. I have entered into a forward contract to sell because I am worried that selling price may fall. There is a change in the fair value of derivative in the first year. Normally we would have recognized in P&L account in the same year. Normally, if I follow general principles of the standard, then what will happen? In the first year, you will have a loss due to derivative, and second year you will have a gain because your price have gone up, selling price have gone up. So 1 year loss of 10, other year gain of 10. So P&L account will be very volatile. So what they are doing, they are just shifting this loss on derivative to next year, because next year when you recognize the sale, you will transfer from OCI to P&L account. So my net effect will be, on one hand we will have a gain here on the hedged item, we will have loss on derivative, so the total is 0. This is called perfect hedge. Even if perfect hedge is not possible, at least hedge is highly effective. So to that extent, your profit and loss account will have minimum impact, lower impact. Okay. Hedge portion into effective portion into equity, ineffective portion into P&L account. Effective portion is lower of the two. Cumulative gain or loss on hedging instrument, cumulative gain or loss in the hedged item, that is change in fair value of hedged item. Now we will solve one question. Is the answer printed in the book? No. Oh. But these are some of the really good questions. Next 6 questions. Entity A is a producer of widgets. Okay. Whatever is that. At least we are understanding the numbers enough. To hedge the risk of decline in the price of 100 widgets that it expects to sell on December 31st, 2018, let us call it 2018, entity A on 1st January 2017 enters into a net settled forward contract. Net settled forward contract means derivative. Net settled means only the net difference will be received or paid. The winner will get the difference, the loser will pay the difference. When was this contract entered into? 1st January 17. When are you expected to sell this widgets? 31st December 2018. That is after a gap of 2 years, not 1 year, 2 years. Assuming a forward contract is available for 2 years, practically little difficult to get a forward contract for 2 years, but still move ahead. During 2007 means first year, the change in the fair value of the forward contract is a decrease of $8,000. Oh, loss or gain? Loss. Decrease in the value means loss. Entry. Entry. Loss account debit to loss to penal account. No, don't worry. At least you have tried, that is good. Keep thinking, we'll come back to this. During 2008, the change in fair value of the forward contract is an increase of $2,000. So we'll pass entry for 2,000. Still we are a net loser of $6,000. First year the fair value has gone down by 8,000. Second year there is a gain of 2,000. So still I am losing $6,000. And to help you, they have given the next line. On 31st December 2008, entity A settles the forward contract by paying $6,000. So they will settle the forward contract by paying $6,000. At the same time, it sells 100 widgets to customer for $93,000. So when was sale recognized in P&L account? 2008, 31st December. So we will transfer the balance in OCI reserve to P&L account in the same year, that is 2018, when the sales will be recognized. So your entry in this year would be OCI reserve account debit to derivative liability account or to forward contract account, because the contract has become unfavorable. Contract has become a derivative contract where there is a potential loss, means it is unfavorable, it is a liability. So any name you can give: cash flow hedge reserve account debit to financial liability to derivative liability to forward contract. Same entry here, but reverse it because there is a gain. And then you settle the forward contract. But cash flow hedge reserve account will have a balance of 6,000. So that we will adjust when we recognize the sale of 93,000. Pass appropriate journal entries. So they have specifically asked pass journal entry on 1st January 17, 31st December 17, 31st December 18. And to help you further, the hedge is fully effective. Means whatever is the change in the fair value of this derivative will be fully transferred to OCI. Will be fully transferred to OCI. So write down in the books of entity A, journal entries, cash flow hedge accounting. Heading is cash flow hedge accounting. 1st January 2017. Write no entry required. No entry required. Because the fair value of forward contract is nil. Because the fair value of forward contract is nil and there is no cash inflow or outflow. And there is no cash inflow or outflow. There is no cash inflow or outflow. Right? What is the next date now? 31st December 20x7. Now on this date, there is a loss on derivative. Value of derivative has gone down. So I will write equity account debit or OCI reserve account debit, cash flow hedge reserve account debit, whatever name you want to write, to derivative liability or to forward contract. How much is the amount? 8,000. In some question we will learn how to calculate it also. So write down narration: being decrease in fair value of hedging instrument. Decrease in fair value of hedging instrument. Decrease in fair value of hedging instrument written. Now come to December 31, 2018. Good news. There is a decrease in the or increase in the fair value of forward contract by $2,000. So now I am going to pass the entry, reverse the entry by $2,000. Derivative liability account debit 2,000 to equity account 2,000. To equity account 2,000. To equity account 2,000. Being increase in fair value of hedging instrument. Being increase in fair value of hedging instrument. Now if you see these two entries, what is the balance in derivative liability account? 6,000. Since it is a forward contract, it is a net settled forward contract, you will be required to pay the difference. And the question also mentions that. Every problem will not mention that. You have to understand yourself. So next entry will settle the liability by paying the difference 6,000. Derivative liability account debit 6,000 to cash account 6,000. Derivative liability account debit 6,000 to cash account 6,000 to record the settlement of hedging instrument. To record the settlement of hedging instrument. This is also clear. Which account is still open now? Equity account. OCI reserve account. 8,000 minus 2,000, 6,000. So this also I will recognize now along with sale. What is the value of sale? Okay, so cash account debit 93,000. To equity account 6,000. To sales revenue 87,000. Or you can pass two entries also. Or you can pass two entries. First you can write cash to sales 93, and then 6,000 you can adjust against sale in the next entry. You want to pass two entries or one? One. Narration write down being sales recorded. Being sales recorded. Okay. And the cumulative balance in hedging instrument and cumulative balance in hedging instrument recognized in P&L account when sales occurs. Recognized in P&L account when sales occurs. In some books they have passed two entries, but the effect is same. You can write cash to sale revenue. Second entry sales revenue to equity. Now some more complicated question we will take. This exam is at a very different level. So accordingly the preparation has to be done. Okay. On 4th January 2012, P Limited has forecasted sale, similar to previous one, forecasted sale of 1 million kg of chemical on 15 December 12. So in this question it is in the same accounting year, okay? 4th January 12, 15 December 12. To L Limited or in UK on 4th January 2012. So in एक second, some sentence drafting. Full stop here. And then on O capital. Is it right? On 4 January 2012, P Limited designate the cash flow of a forecast sale as a hedged item. On 4th January 2012, this is the date when we are forecasting a sale. we have decided to call it a hedged item and enters into a forward contract to sell 4 million pound. Why 4 million pound? Because quantity is 1 million kg and the rate is 4 pound per kg. So 1 million into 4, 4 million pound, and entered into a forward contract to sell 4 million pound based on the forecast receipt, that is 1 million into dollar pound 4 per kg. The forward contract locks the value of the pound to be received at the rate of rupees 80 per pound. So you will receive the payment in pound, 4 million pound, and 4 million pound will be converted into rupees 80 per pound. Okay. At the inception, the fair value of the forward contract is 0. Very good. On 30th June, means after half year, the fair value of the forward contract is minus 1 lakh. So loss. Like previous question, pass the entry. Minus sign means loss. On 15 December 12, the transaction occurred as expected. The transaction occurred as expected means you will sell 1 million kg of chemical at 4 million pound and the bank will release 80 rupees per pound to you. The transaction occurred as expected. The fair value of the forward contract is rupees 1,50,000. The fair value of the forward contract is rupees 1,50,000. Exchange rate is declining against rupee as rupee continued to weaken against the pound. So first you will pass an entry for loss of 1 lakh here. Again you will pass an entry for loss of 50,000 here. And then you will pay that 1,50,000 difference. Is it right? Pass journal entries. Today I am going to ask you a question. You have entered into a forecast sale of 4 million pound. You have entered into a forward contract to sell 4 million pound. Is it right? At what rate? 80 rupees per pound. And on the expiry date, the value of the forward contract is minus 1,50,000. Which means the exchange rate on 15 December was how much? SFM question, strategic financial management. Will it be more than 80 or less than 80? Calculation we will do later, huh? Less than 80, more than 80. When you enter into a forward contract to sell, okay, at least this is sure we have entered into a forward exchange contract to sell 4 million pound. There is no doubt on this because the question itself says enters into a forward contract to sell 4 million pound. When you sell, when would you lose when you enter into a forward contract to sell? When the rate goes up or when the rate comes down? Okay, I'll revise forward contract. Okay, a forward contract is a right to buy or sell a specified quantity at a specified price. There are two parties, buyer, seller. Buyer makes the profit when the rate goes up. Seller makes the profit when the rate goes down. Reverse. Buyer suffers loss when the rate goes down. Seller suffers the loss when the rate goes up. So my fourth sentence was, the seller of a forward contract suffers loss when the rate goes up. It means the rate has gone up. And the value of that is 1,50,000. It means 4 lakh pound multiplied by the change in the rate is equal to 1,50,000. Is it right? So the market rate would have been higher than 80 rupees per dollar per pound on that date. Keep that in mind. So that is why I said little difficult one. Because the student has to visualize that if I have taken a forward contract to sell and the problem says I have suffered a loss, it means the rate must have gone up. Rate must have gone up. Why we are discussing that issue? Because when you will receive the dollar or pound in this example, you will convert at the market rate. And for the forward contract, you will receive the net or pay the net difference. Is it right? The two contracts will be settled separately. Which two contract will be settled separately? Sale contract, you will settle separately by converting into rupees at market rate. Forward contract, you will settle separately by paying the difference. Okay. Okay, at least write first few entries which are easy. Again, we'll discuss. Too much information load may confuse you. 4th January 2012. No entry. They have also mentioned in the question. The fair value of derivative on inception is nil. Is it mentioned? Even if it was not mentioned, we will assume the same, because the fair value of forward contract is nil. And there is no inflow or outflow of cash. And there is no inflow or outflow of cash. Go to 30th June. 30th June, this hedging is for hedging your future sale value. So this is for hedging your future cash inflow. Okay, so it is a cash flow reserve. Cash flow hedge accounting. And this time we have given a name called cash flow hedge reserve, in bracket OCI. I will recommend in the exam you also write the same name, because it conveys all messages. Cash flow hedge reserve OCI. 1 lakh. This is a loss. So my reserve account will become negative 1 lakh. This is a negative reserve. And to forward contract 1 lakh. Or you can write to derivative contract 1 lakh. Narration being forward contract. Being forward contract recognized at fair value. Being forward contract recognized at fair value, and effective portion is recognized in OCI. An effective portion is recognized in OCI. An effective portion is recognized in OCI. Okay. And then come to 15 December. The fair value of forward contract has moved from minus 1 lakh to minus 1,50,000. This time it is loss on both the occasions. Previous problem, loss on the first occasion, gain on the second. But this time loss. So pass the same entry for the difference amount. 1,50,000 minus 1 lakh. Cash flow hedge reserve account debit OCI 50,000 to forward contract 50,000 being changed in fair value of forward contract recognized in OCI. Change in fair value forward contract recognized in OCI. Then we'll pay the liability. 1 lakh and 150,000. Total amount payable in forward contract is 1,50,000. We are the losing side. We are on the losing side because probably the exchange rate must have gone up above 80, and therefore we are required to pay the difference, which they have calculated for us 1,50,000. So forward contract account debit to bank account 1,50,000. Being cash paid to settle the forward contract. Being cash paid to settle the forward contract. You will assume in the exam all forward contracts are net settled. Okay, if nothing is given. Wait a minute. You still have a balance of 1,50,000 debit in cash flow hedging reserve. Now the problem says the sale occurred as anticipated, and then you will get 4 million pound in payment. At 4 million pound, you are going to convert into rupees. How many rupees you will get? Anybody? Any guess? How many rupees you will receive? 32 crore. Why 32 crore? Why 32 crore? You multiplied by 80. But that 80 is the forward rate. Market rate is not 80 now. Market rate has changed. That is why you got that. You paid the difference of 1,50,000. Market rate is not 80. Forward you have settled separately. So now you will receive the pound and convert into actual market rate on this date. And that you will be writing more than 80. We don't have to do actual calculation. It is 32 crore, what you said, right? And you also add 1,50,000 because the rate has increased, whose value is 1,50,000. Whose value is 1,50,000. Okay. The increase in value of the pound for this 4 million pound is equal to 1,50,000. Okay. So you will receive, add 1,50,000 to 32 crore. The fact that you have paid 1,50,000 rupees in this deal means the rate has gone up, and the total value of that increase for $4 million is 1,50,000. Otherwise, first we'll have to find out the rate. 1,50,000 divided by 4 million. That will give me the rate. And then that rate multiplied by your 4 million. 80.0375. You are a good student. 80.0375 is the rate. You are right. After that 1 year period. So either you can do that first. Or you can directly just add 1,50,000. Many students are wondering why we are not writing 32 crore. You have already paid the difference here. Now you see the benefit of using the forward contract. You have locked the amount. This figure has gone to your P&L account. But at the same time, this derivative cash flow hedge reserve account, now this also I will transfer to P&L account. Sales means ultimately P&L account only. So this time we have passed two different entries. Previous problem I had passed one because I wanted to explain to you in little more detail. So when you recognize the sale, when the respective cash flow is recognized in P&L account, at the same point of time, the balance in cash flow hedge reserve is also recognized in P&L account. Then some students think, sir, where is P&L account? You have written sale. Where is sale? Sale is also P&L account only, na? In bracket write P&L account. Sale means P&L account only. What is the net effect of this entire thing? Your sales will appear at 32 crore rupees in the P&L account. That is actually exactly 32 crore as per forward contract. Okay. So this is the advantage of cash flow hedge accounting. It will prevent the volatility in P&L account. Suppose sales would have taken on 1st of January next year. So this year in otherwise you will recognize loss. Next year you will recognize more sale. So loss in 1 year and more profit in another year. But actually, I know that these two transactions are interlinked only. So I am going to receive 32 crore only. I am going to receive 32 crore only. So that is the benefit of hedge accounting. Okay, we'll try one more. As we'll move ahead, the questions will become little more complicated. One of these questions will be asked in your exam. On 30th September 2017, NTTA hedges the anticipated sale of 24 tons of pulp on 1st March 2018. Anticipated sale means forecasted transaction. Anticipate, we want to sell, but there is no firm commitment to sell. So such transactions will be hedged through cash flow hedge accounting. Anticipated sale, forecasted sale on 1st March by entering into forward contract. So in order to avoid the risk, they have entered into a forward contract so that the rate is locked. The contract requires net settlement in cash, determined as the difference between the future spot price of pulp on a specified commodity exchange and rupees 1000. Entity expects to sell pulp in a different market. It determines that the forward contract is an effective hedge. On 31st December 17, that is my year ending date, the spot price of the pulp has increased both in the local market and in the exchange. The increase in the local market exceeds the increase in exchange. As a result, the present value of the expected cash flow from the sale on the local market is 1100 and the fair value of the forward contract is 80. Past journal entry. Half of the world has not understood only what is this question. Normal layman will not understand the question only. What is the change in the present value of expected cash flow from the sale in the local market? Earlier I was expecting that it will be sold for 1000 rupees. Okay. But now the change in the price is such that the present value of expected cash flow is 1100. So how much is the change in the fair value of change in the present value of cash flow from the underlying sale contract? 100 rupees, not 1100 rupees. We were expecting to sell at 1000 earlier. Now we are expecting to sell at 1100 rupees in present value terms. So the cumulative change is 100 rupees. Cumulative change in the hedged item is 100 rupees. And what is the cumulative change in the fair value of the forward contract? 80 rupees negative. Of course, one will go up, the other will come down. Then it is only effective hedge. So you have a gain of 100 rupees here and you have a loss of 80 rupees here. So now as a student, tell me whether this 80 is effective or ineffective or partly effective and partly ineffective. Three options I have given: fully effective, fully ineffective, partly effective and partly ineffective. So the answer is fully effective because this loss is less than 100 rupees. Okay, this loss is less than 100 rupees. So therefore it is a fully effective hedge. So entire 80 rupees will be OCI. Entire 80 rupees will be transferred to OCI. But in the exam, suppose this figure was 120. Instead of minus 80, it was minus 120. Then 100 is effective. 20 is ineffective. So 100 would have gone to OCI. 20 would have gone to P&L account. Okay. So write down a small note first, then one journal entry we will write. We have to only pass journal entry for the hedging, because we don't know when was the contract settled. On the year ending date, the data is given. On 1st March 18, the details are not available. The details are available only up to 31st December. Have you noted? So you will pass entry only on 31st December. First write down, check for hedge effectiveness. Check for hedge effectiveness. Cumulative change in the fair value of forward contract. Cumulative change in the fair value of forward contract, 80 rupees. This is given in the problem. We are also going to solve questions where we will calculate this first ourselves and then do the accounting. Okay. So slowly and slowly the problem will become more and more difficult, but we'll go in the step by step manner. Now write down B, cumulative change in fair value into bracket present value of expected future cash flow of hedged item. Of expected future cash flow of hedged item. In bracket write 1100 minus 1000 is rupees 100. Now write one note. In this example, write in detail. Afterwards, when you read your answer, there is no confusion. In this example, there is no ineffectiveness. There is no ineffectiveness because the cumulative change in fair value of hedged item, exceeds the cumulative change in fair value of forward contract. Exceeds the cumulative change in fair value of forward contract. We are given detail of only 31st December 17. So we'll pass entry on 31st December 17. What about 30th September 17? No entry. Either you can write 30th September 17, no entry because fair value of forward contract is nil at inception. Or you can directly write 31st December 2017, cash flow hedge reserve account debit 80 to forward contract account 80. Being change in fair value of forward contract recognized in OCI. Being change in fair value of forward contract recognized in OCI. Okay, this much. So in the exam, what they will do, they'll give you this question for 4 marks. Now in the next question, I'm going to tell you how to calculate these numbers itself and then accounting. Keep the calculator ready. Such questions are a mixture of knowledge of financial management subject and of course this chapter accounting. But some knowledge of financial management would be required here because forward contracts are mentioned, many dates are mentioned. ASF Limited planned to purchase goods amounting to $10,000 in 9 months' time. So from today, add 9 months and we want to enter into purchase of goods transaction. Previous 2 or 3 examples were on sale. Is it right? Now purchase. So if I have to purchase in dollar, what is the risk? Exchange rate will go up. My cash outflow will increase. So what will I do with respect to forward contract? I'll enter into forward contract to buy dollar or sell dollar at a predetermined rate. Buy dollar, so that your rate is locked. And if the rate goes above that, you will gain. If the rate falls below that, you would lose. Okay? So this much knowledge about forward contract I expect from you. You will enter into a forward contract to purchase dollar. Second, if the rate goes above your contracted rate, you would gain. If the rate falls below your contracted rate, you would lose. Okay. So now you see date, exchange rate, closing exchange rate means on this rate, this is the market rate. So these are the market rate on these dates. And these are the forward rates on this date. Now what is the difference between these two columns? If I want to buy dollar today on 1st January 15, then I will have to pay 62.20. If I enter into a forward contract today for 9 months, which is what we did in this problem, then we will enter into a forward contract at the rate of rupees 62.40. So forward contract was entered into at 62.40. And then what happened on 31st March? The exchange rate has moved from 62.20 to 62.40 in the spot market. This will help me to calculate the cumulative change in the fair value of hedged item. And then forward rate has also changed. Now if I want to enter into a forward contract, then a forward contract for 6 months. Why 6 months they have mentioned? 3 months are over. So if I now enter into forward contract, I need to enter into only for 6 months. And now from the forward rates, it is seen that the rates have gone up. So are we gaining or losing? On forward we are gaining. On forward we are gaining. But on the spot we are losing. Same thing here also. 63.67, 63.75. So we have to compute the cumulative change. Means every time I will take opening balance as a base and go up to that point. That difference is my cumulative change. Again I will compare 1st January with this figure to compute the cumulative change. And then finally on 30th September, this was the rate. So at this rate we will be able to purchase the dollar. But then I have entered into forward contract at 62.40 and the rate closes at 64.10. So I will have gain. So till this contract is recognized as purchase, this change in fair value of forward contract, lower of the two will be recognized in OCI. Which lower of the two? Change in fair value of the hedging instrument, which is forward, and cumulative change in the present value of hedged item. So in this question we have to compute present value also, because below the rate is given. So if the rate is given, interest rate, discount rate, present value factors are given, then you have to apply that to find the present value. Okay. You'll ask, in previous two questions you have not done. Everything was given on a platter. You have to just eat it. Now you have to do the farming, grow the wheat, then make bread and then eat. The best estimate for the projected rate on 30th September 15 is the forward rate of the appropriate term. Past journal entries. So underline this sentence, the best estimate for the projected exchange rate on 30th September 15 is the forward rate of the appropriate term. So what is my expected exchange rate? Expected exchange rate is what is rate available on the respective date. So on 1st January we will expect that we will receive 62.40. On 31st March we will expect we will receive 62.55. On 30th June we will expect we will receive 63.75, like this. Finally we ended up receiving 64.10. Past journal entries. But to pass journal entry, you need to first find out the effective portion and the ineffective portion of the hedging instrument. And for that you need to compute the lower of the two, cumulative change in the fair value of derivative and cumulative change in the present value of cash flow of the hedged item. So for that we have prepared this small table. Draw the table. Very few books give you this calculation, okay? And even if they give you, it's very difficult to interpret. So heading right down, write first calculation of hedge effectiveness, cash flow hedge reserve. Write here highly probable cash flows. This column is for calculating the change in present value of your cash flow, and this column is for calculating the change in the present value of your derivative, cash flow hedging reserve. And then we will choose lower of the two for accounting purpose. So one effect will go to OCI account, one effect will go to currency forward asset account, or just forward contract account. Is it right? Say yes. Yes, very good. In this question we have purchased forward contract and the rates are increasing. That means we would be gaining. We would be gaining in forward contract. Have you drawn the format? Now listen to me carefully and then write. Do not do stunt on your own. Even though you are intelligent, highly probable cash flow in USD and in INR. Then cash flow hedge reserve. We will compare this column with this column, and then we will decide to pass the entry based on lower of the two. One effect will go to OCI, the other effect goes to asset account. Forward contract asset account debit to OCI account. Why we have written asset, why not liability? Because the rates have been increasing and we are the buyer of forward contract. So buyer gains when the rate goes up. Understood? Now write down 1115. 1115 initial recognition. The problem says in one sentence, the best estimate for the projected exchange rate on 30th September 15 is the forward rate of the appropriate term. So we are expecting that we will receive 62.40 because that is the forward rate available today. I inquire in the market, what is the expected rate after 9 months? The market tells me 62.40. So I will receive $10,000 into 62.40. But when will I receive? After 9 months. So the present value will be formula future value upon 1 plus R. Is it right? So 1 plus R. R is rate of interest 8%, but it is only for 9 months. So into 9 by 12. Because we are only 9 months away from maturity. Now this calculation you should know. Why we are multiplying? Because we are calculating present value of a cash flow which will take place after 9 months. This 8% is per annum figure. So we have to adjust the rate for 9 months into 9 by 12. Now do the calculation and give me this amount. Just check, is it right? Have you checked? So this is what I was expecting to receive on 1st January. Then I come to 31st March. On 31st March, when we inquire from the market, what amount I will receive after 6 months? The market says, oh, you will receive 62.55. Can you see 62.55 forward rate? But this amount I am going to receive after 6 months. Now I am standing on 31st March. So I am expecting to receive 10,000 into 62.55. But after 6 months, therefore I will calculate present value 1 plus 0.08 into 6 by 12. Why 6 by 12? Because 31st March and 30th September has a gap of 6 months. There's a gap of 6 months. So take your calculator and tell me, is the amount 601442? This is called change in present value of cash flow from hedged item. So right below, therefore, expected loss on highly probable forecast transaction. Or you can write like previous answer, expected change in present value of cash flow. Whatever you understand better. Now, since it is a purchase problem, if I end up paying more, I would lose, correct? The question is why we are writing in negative? Because it's a purchase transaction. I was expecting to purchase at this value, but because of change in rates and this time value of money also, of course, now the expected purchase value in present value term is this much. So if you are going to buy something whose value goes up, you are going to lose money. Now I am going to do this calculation. At what rate we have entered into forward contract? 62.50. Then on 31st March, what is the forward rate? 62.55. So I am gaining. How much I am gaining? 0.15. Very good. But you are not going to get this gain now. After 6 months. So I have to calculate the present value. So below this write down currency forward. This table will continue for one full page. If you are drawing lines, draw one full page. Same exercise I have to do on 30th June also. Same exercise I have to do on 30th September also. 3 times we have to recognize the change in fair value. Now you see the calculation. You correctly said there is a gain of 62.55 minus 62.40. This is the gain per unit of dollar into $10,000 involved upon 1 plus 0.08 into 6 by 12. 6 by 12, whatever date you will write here, 31st March, with respect to that date and the maturity date, you have to see what is the gap. 6 months. So I will take 6 months. Because all calculations we are doing in present value terms. So is it 1442? Take calculator. 62.55 minus 62.40 into 10,000 divided by 1 plus, this will become 0.04. So you'll get 1442. This is gain. This is loss. Ignoring the negative sign, choose the lower of the two. Which is lower? 1442. So is it fully effective or partly effective? Partly effective. No, fully effective. Give me one final answer. Fully effective, because the change in derivative is lower than the change in the hedged item. So if the change in derivative, previous note you refer, you've written the hedge is fully effective because the change in hedging instrument is lower than the hedged item. Same thing applies here also, na? This column is for hedged item. This column is for hedging instrument. If it is lower, then it is fully effective. So I will pass an entry for 1442. Entry I will write later, but for the timing, my entry will be currency forward asset account debit 1442 to OCI cash flow hedge reserve OCI 1442. Done. So remember, we have two accounts opened now, OCI and forward asset. Forward asset debit balance, OCI credit balance 1442. Now come to 30th June. The problem says the best estimate for projected exchange rate on 30th September is the forward rate for the appropriate term. So when I come to 30th June, I find that the market rate is, forward rate is 63.75. So I am likely to realize 63.75 now. But after how many months? 3 months. So compute the present value. Take on your calculator. 10,000 into 63.75 divided by 1 plus this 0.08 into 3 by 12 will be 0.02. Is it 6,25,000? Check the calculation. Okay, now tell me cumulative change in the present value. Cumulative change in the present value of cash flow. Cumulative change. I'm asking you a question. Take this number 6,25,000. Compare with which number? 588,679. From the beginning till now, what is the change? Yes, 36,321. Don't look at two near numbers, 6,25,000 and 6,1442. Don't look at those two numbers. Cumulative. In order to calculate the effectiveness, cumulative we will see. This is the purpose of just to check the effectiveness. Okay. So the cumulative expected loss on highly probable forecast transaction is 36,321. Why we have written loss? Because we have to pay more amount in rupees terms. We are going to purchase, goods. And if you purchase goods and the amount payable keeps on increasing, means there is a loss. Had it been a problem of, say, sale, we would have written gain, because then we'll receive more. Okay, now you calculate the cumulative change in currency forward. Right, cumulative change in currency forward. Now the forward rate for 3-month maturity is 63.75. And I had entered into forward contract at 62.40. So the cumulative change in the forward rate is 63.75 minus 62.40. This is the change in fair value into 10,000, total change in fair value, upon 1 plus 0.08 into 3 by 12. 3 by 12 means from 30th June to 30th September, 3 months. 0.08 is the interest rate. This is the formula for present value, future value upon 1 plus R to the power n. Just check the calculation. Is it 13235? 13235. So this is the cumulative change in fair value of derivative. Choose the lower of the two. Which is the lower of the two? 13235, and this is 36321. Again it is fully effective. Again it is fully effective because it is less than this change. So this much is the total change in fair value of derivative so far. I have already accounted for 1442. I have already accounted for 1442. So now I will pass the entry for the difference amount in balancing amount, which comes to 11793. Which comes to 11793. So now I am going to pass an entry on 30th June. Forward asset account debit to OCI account 11793. Don't worry, I am going to give it. And then my balance in the balance sheet will be 13,235. Okay, now we will try 30th September. Do we need to compute present value? No, today is the maturity date. So the time is 0. Time element to maturity is 0. So now two simple calculation. As far as this highly probable transaction is concerned, I will receive 64.10. Can you see on 30th September, finally the market rate is 64.10. So you will purchase dollar from the market at 6,41,000. And how much is finally your gain or loss on the hedged item? Sorry, hedging instrument. You entered into a forward contract at 62.40. And now the market rate of dollar is 64.10. You have entered into a contract to buy. You entered into a contract to buy, and the rate has gone up. So you will gain the difference into 10,000. Is it 17,000? One more thing, I have to calculate cumulative change in highly probable forecast transaction. It will be 6,41,000 minus 588,679. So just write here, which I have not written, cumulative expected loss or change in highly probable forecast transaction. Take this number 6,41,000 minus the first number 588,679. How much is that? 52,321 loss, and this 17,000 is the gain. So again I will take 17,000 only. Again I will take 17,000. I have already accounted up to 13,235. I have already accounted the gain up to 13,235. So in the next round, I am only going to account for the additional gain, which is the difference between total gain 17,000 minus gain recognized up to 30th June 3765. After passing this entry, my asset account will have a balance of 17,000. Then I will receive 17,000 under forward contract as a gain, and I will pay 6,41,000 to purchase the goods. So my net effect in the P&L account will be now the difference between the two, because then 17,000 also I will transfer to P&L account. The day I will recognize the purchase on 30th September, on the same day I will transfer the balance in OCI also to P&L account. So now write down journal entries. Keeping this table in front of you. First entry, write down 1st January 2015. No entry, because the fair value of forward contract is nil. Because the fair value of forward contract is nil. some numbers are not used to solve the problem. For example, the closing exchange rate on given dates are not used to solve the problem, as the problem says the exchange rate that you are expected to realize will be equal to forward rate. Now keep the table in front of you. On 31st March, we had a gain equal to 1442. So your entry will be currency forward asset account, forward contract account, currency forward asset account, derivative asset account. Give some name. No need to remember. To cash flow hedge reserve OCI account 1442. To cash flow hedge reserve account 1442. Being change in fair value of forward contract. Being change in fair value of forward contract. For the effective portion. For the effective portion is recognized in OCI. For the effective portion is recognized in OCI. And then you repeat the entry with additional gain 11793. Is it there in your table? 11793, 30th June. 30th June. Same entry, change the amount. Narration, no need to write again, same narration. Currency forward asset account debit to cash flow hedge reserve OCI account 11793. Again repeat the entry. On 30th September. What was the additional gain on 30th September? 3765. Those who have completed, write 30th September on your own. Same entry, amount will be 3765. Currency forward asset account debit 3765 to cash flow hedge reserve account OCI 3765. Narration is same. And then you settle the forward contract. You will receive the difference. You had entered at 62.40 and on maturity it is 64.10. You have bought forward. You are a gainer. You will receive the difference. Bank account debit 17,000 to currency forward asset account 17,000. So which of the two accounts gets closed here? Currency forward asset account. You receive the difference. Asset is settled. Asset is derecognized. Derecognition principle. When the future right to cash flow expires, now no longer you are going to get anything out of it. Derecognize. But you still have a balance in cash flow hedge reserve account 17,000. That I will transfer to P&L account when I will recognize the corresponding purchase item. Now I go to purchase the goods in the market. Market value of dollar is 64.10. So I need to pay $10,000. So I will buy dollar from the market. Entry, purchases account debit to bank, 10,000 into 64.10. But don't worry, you have earned 17,000 rupees. So your effective purchase cost will get reduced. So write one more entry. Cash flow hedge reserve account debit. Cash flow hedge reserve account debit 17,000 to purchases account 17,000. So what is my net purchase? Take 641 minus 17. 624. This is exactly what we wanted. 10,000 into 62.40. This is what we wanted. Yes or no? So this is how you do the accounting under cash flow hedge. Now we will take a break.